Thanks everybody for listening in. My name's Arnold Machel. I'm the founder of VisionVest Financial. We're going to be doing a quarterly investment review for the Counsel Balanced Portfolio. The odds are you're tuning into this because you got an email from us letting you know that this is your core holding, or maybe you're just somebody new wanting to check it out. Either way, we're going to give you a quick update as to what's going on in that portfolio since the beginning of the year. A lot of the slides that I have are actually as at the end of March, but we'll be giving you a more current update than that. So what's the balanced portfolio? Just really briefly here, if you're invested in this portfolio, it's probably because you want a better growth, but you also want to protect your capital. That's what it's all about. It's got a dedicated weighting of about 40% to fixed income, or I should say a target weighting to that, and 60% to equity. Although right now it's actually closer to 50-50. We'll talk about that a little bit. What I really want to point out here, though, is this is truly a balanced portfolio as opposed to a balanced fund. It's also classified as a balanced fund, but really it's got 17 different funds built inside it. So for example, I'll highlight two of them here. The Global Trend Strategy by Mount Lucas. Mount Lucas manages that. It's a fund in and of itself. Mount Lucas is a manager in and of themselves. Also want to just point out US Growth. We'll talk about them a little bit. Morisco, also a fund manager. There is a US Growth fund, and Morisco is a manager that's one of their specialties. If you're ever interested in any of these specific individual pieces inside the fund, we do have audio casts available from many of the managers. If you're ever interested in those, reach out to us, let us know. We'd love to send those links out to you. So, bad news is, now this is as at the end of the quarter, so as at the end of March 31, this portfolio had dropped 11.25%. Right now, that's closer to around -5, -6%, so it has come back probably about half of what it lost at that point. So it did a great job protecting us on the downside, and it's slowly coming back, just like what we would expect. I think really what I want to point out to you here is this is within the range of what we would expect the portfolio to do once in a while. So on the right-hand side here, you see a graph and a set of numbers that correspond. And what they tell you is this box, the brighter green, is the most likely range of returns. It's what you're going to earn 70% of the time. But once every 4 or 5 years, it's going to be outside that range. It's going to be in once every 4 or 5 years, it's going to fall in that range, as much as losing 20.5% or gaining 29%. Most of the time, in between the -3 and +14, but once in a while, like we're experiencing right now, within the -20 to +29 range. 1 year is less important than what can you expect in 10 years, and it compresses quite a bit. So realistically, over a 10-year period, if you own this portfolio, almost for sure, it's going to range between 4.6 and 8.9%. But most likely, it's going to range, if you're holding this 10 years from today, somewhere in that 5.2 to 7.5% range. Now, I should point out, this is gross of fees, so whatever your advisory fee is, you got to knock that off of it. So, knock 1.5% or whatever your advisory fee is, you want to knock that off of there to get what you would expect out of the entire portfolio. All right, so as I said, the fund, the target range is 60-40 equity to fixed income, but that one company that I mentioned earlier, the Global Trend Strategy, they represent about 11% of the portfolio, and they had a little bit in bonds. You see here about 11% in short-term US bonds. That's going to be a lot like cash. It's not exactly the same, but they moved from that to more than 99% in bonds. And then as the market has strengthened, they've been reducing their exposure to those bonds down to 87% in mid-April, and actually as low as 78% today. Another thing to point out about this portfolio, during the highly volatile period, their hedge against currency. One of the things I love about this portfolio, they currency hedge dynamically. And what I mean by that is they adjust the hedge based on what they think the currency is going to do. They were 50% hedged against the US during the really volatile period. It's actually been trimmed down to 0 against the US, and they do have a 25% hedge against the euro. So whatever portion of this portfolio is denominated in euro dollars, a quarter of that is hedged. Long and the short of it is they think that the Canadian dollar is going to fall, and so they want to remove the risk of the portfolio doing poorly by hedging that currency. All right, so what worked well was fixed income. You know, it's no big surprise. You get a downturn in the stock market, fixed income is what saves you. What was a bit of a surprise was the US growth. That also performed very well. Once we drill down to it, it becomes a little bit more evident why that did well. It was a bit of a surprise to begin with, but then when you look at it, Amazon, that's a big company in the US growth sector. Well, Amazon's doing really well during this time period. And not just a short-term blip, at least I believe. A lot of consumers, it's going to be their first experience to buying online. They've broken that barrier. The odds are, even if they don't keep up at the same pace as they are now, the odds are they're going to continue to buy stuff online. So all online retailers, which would be in that US growth category, or in the growth category, I should say, but a lot of them in the US, they are doing well. What hasn't done well? Value. As a style, value just for the last few years, value has been poor. And again, it was a bit of a surprise during this downturn, value continued to underperform. And it didn't matter whether it was US, Canadian, or overseas value, all of those sectors did poorly. Well, we'll see what that looked like on the next slide here. But at the end of the day, really, what I can tell you is the diversification that we had really was to our benefit. It prevented this portfolio from going down near as much as the broad market and has helped with the recovery. Don't want to spend too much time on the slide, it's a bit busy, but I'm going to get you to focus on the green, the year-to-date numbers. The blue are 3-year averages, but the year-to-date sort of gives you a bit of a picture. Now this is as at the end of April, but close enough. Things are generally a little bit better right now than they were then, but you know, it gives you a pretty good picture. You can see here, US growth, fixed income, short-term bond, those are the categories that actually made us money during this time period. Everything else didn't. Everything else was negative. And in fact, what was the worst? It was the value, the dividend, and the value there. So the importance of having each one of those sectors represented inside the portfolio just helped to mitigate the downturn. Probably the single most important thing that I can focus on here is the importance of you keeping a long-term perspective. This is just a quick look at the TSX. The last 6 times it dropped significantly, and you can see there those were all drops of greater than 20%. In the next 12 months, in the following 12 months, 5 out of the 6 times markets were nicely positive, and 6 out of the 6 times 5 years later they were very positive, all except for 1 year. At one time it was somewhat positive, 8% a year on average for the 5 years after the May 1970 drop. So maintain that long-term perspective. We're going to be in good shape if we hang in there. Thanks for listening in. If you're an existing client, you've got our contact information. If not, it's right here. Please reach out to us. We'd be happy to chat with you about this portfolio or anything else. Thanks again for listening. And if I save $1 million, if he saves $1 million, I'll have less to worry about until the day they carry you out. If I save $1 million, reinvest that $1 million. Well, I'd buy Arnold lunch. He'd deserve at least a good sandwich. If I'd save $1 million, I would save